be wondering why I write books, and there's a very simple explanation for it, because people said to me, "Are you Stephen King, the author?" I can now say, yes, I am, which is that particular problem. The message of this book is really very, very simple, that we've been going through many, many years of really quite rapid increases in living standards. And on the basis of those increases in living standards, we've happily assumed that those increases will continue into the future. On the basis of that assumption that the increases will continue into the future, we've happily spent tomorrow's income today. We're now discovering, however, that tomorrow's income wasn't quite as high as we had expected it to be. So there's basically a really rather large shortfall that's come through between what we expected to happen economically and what actually has happened. Yet despite that shortfall, we still have tremendous commitments in a whole range of areas which had assumed that those income gains would continuously come through. So what's the evidence for the shortfall? Well, very simple. This is actually an important year for me, not just because the book is coming out, or has come out, but also because it's an important year from a birthday point of view. It's not my 30th birthday, and it's not my 40th, unfortunately, either. It's not my 60th, it's somewhere in between is my birthday for this year. And I was thinking about how the UK economy had developed over the last 50 years, and my life so far, how the growth rates have changed. And I'm going to focus here on per capita increases in GDP. And the numbers really are quite remarkable. In the first decade of my life, there was an increase in living standards of around about 36–37%, so a very big increase in a short space of time. The second decade, an increase of 13%. There was a very good explanation for why it was that things were so weak back then. It was the first oil shock, the second oil shock, the recession at the beginning of the 1980s, all these things that really dampened down growth quite significantly. In the third decade of my life, there was an increase of around about 24–25%. The fourth decade, an increase of over 30%. That takes us to 2003. Over the last 10 years, there's been an increase of only 4%. So much, much weaker than anything we've seen over the last previous 40 years. In fact, it's been the weakest decade that we've seen in the entire post-war period. And that's, I think, a really rather significant challenge. Why has it been so weak? Well, the first and most obvious explanation, of course, is the financial crisis itself. But it's worth stressing that around the Western world, the economic growth numbers are slowing down even before the financial crisis, particularly actually in the US, which is often held up to be a good example of a recovery from the crisis. Actually, US growth has been disappointing over the last 10 years relative to earlier decades. But there are other, I think, longer-term factors here as well. One of which is that the period from the 1950s through to the end of the 20th century saw an amazing flourishing of world trade. That's still going on, but not really affecting Europe, North America, or Japan. It's mostly a South-South story now, affecting China, India, the Middle East, Sub-Saharan Africa, Latin America. It's a sort of different geographical story from what was the case previously. And there's the emancipation of women in the workforce. Very few women actually employed in the 1950s. A huge increase in supply of labour thanks to the emancipation of women over the last 40 or 50 years. That process is not quite over, but most of the benefits have already come through. So again, something that's likely to fade in the years ahead. There's also a dirty phrase I wanted to use, which is consumer credit, which of course is a dirty phrase now, but actually was a really powerful part of the story of continued gains in economic activity from the 50s through to the 1990s. And this, of course, is a story about consumer credit allowing more consumption, which meant more production, which meant more mass production, and therefore effectively meant much more efficient and lower cost production than was the case previously. That was all absolutely fine up until 2007, but has gone wrong since then. Now, many of the decisions that were made, particularly over the last 10–15 years, on, say, the public policy front, particularly in public spending and tax cutting, were made on the assumption that we'd have continued rapid growth. And that turns out to have been a false assumption. I'll give you two examples to show that I'm not really particularly biased in this story. One example is on public spending, and the other example is on tax cutting. The first example comes from the UK. Public spending as a share of GDP measured by the OECD, so these are internationally comparable numbers. Public spending was about 36% of GDP back in 2000. By 2012 it was almost 50% of GDP. It's a massive increase in a relatively short space of time. It wouldn't have been quite so high had growth been a lot stronger. But it's worth stressing here that it wasn't just a consequence of the financial crisis that public spending rose so quickly. because 2/3 of that increase occurred before the financial crisis. So the financial crisis had some role to play, but it wasn't the only role. On the other side of the Atlantic, there was much more a story about tax cutting rather than public spending increasing, but the same consequences come through. In both cases, we've ended up with much larger budget deficits than was expected. And it was certainly true that from 2000 through to 2006, so this is well before the onset of the financial crisis, both sides of the Atlantic became increasingly dependent on fiscal stimulus. Those who call for extra fiscal stimulus today, I think, are forgetting we already had a massive amount of fiscal stimulus in the first few years of the millennium. And actually, you do a comparison here between where we are today and, say, where Roosevelt was when he inherited a depression in 1932-33. Back then, the US budget deficit was only 2% of GDP, so lots of room for fiscal expansion if you really wanted to do it back then, but very little room today to deliver the same kind of outcome. So what we have is a story which I think fits very nicely with a description of the economy which came from Adam Smith many hundreds of years ago. Adam Smith, brilliant economist of course, came up with a particular description of economies and economic state. He described the progressive state, the dull state, and the melancholy state. There's delightful descriptions of it, avoiding any kind of econometric terminology altogether, which is great for me. But what he meant was that there was a moral benefit of economic growth, which is associated with the fact that if you have a progressive state where everyone's living standards are rising, where everyone's being better off, then even if you get increases in income inequality, even if there's some tax avoidance somewhere, even if someone's got their hands in the till, it didn't matter too much because no one was actually losing out in a sort of absolute sense. Maybe some relative winners and losers, but in an absolute sense, no one was losing out. So the progressive state was great because you could forgive certain sins without anyone really being affected too much. Then he talked about the dull state, which would be really a continuation of economic stagnation, and the melancholy state, which is supposed to be associated with contraction today. And what he worried about wasn't just the fact that these economies weren't expanding, but rather that in a dull or melancholy state, one person's gain would be regarded by society as another person's loss. And in those circumstances, it becomes increasingly difficult to run a society in a reasonably stable fashion. If you want a great 20th century example of this, it's Argentina, which was one of the richest countries in the world in 1900. But as a consequence of stagnation and then increasing corruption and so on and so forth, and abuse of property rights and whatever else, it all went rather horribly wrong over the last 50 or 60 years. So, Smith predicted there'll be a breakdown of trust. And that, I think, is precisely what we've seen over the course of the last few years. It's not just trust in banks, and I put my hand up here and admit that banks have been partially responsible for breakdown of trust. It's also a breakdown of trust in Westminster, in politics in general. It's breakdown of trust across society more broadly. I use the example in the book of comedians like Jimmy Carr, for example, avoiding paying taxes. So there's a whole series of examples in society of where trust has broken down. And the problem with trust breaking down is that markets thrive on trust. When you go along to your local fruit market and you talk to someone who's selling fruit, you've got to trust what that person is selling. Trust is an absolutely vital ingredient of markets. And when you have stagnation and growing mistrust, actually the danger is that stagnation gets locked in for the long term. So how do you fix this problem? Well, if you're a person who believes in monetary and fiscal stimulus, you have what I call the theological option. You pray for a strong recovery. There's been lots of that going on over the last few years. Unfortunately, as you may have spotted, the prayers haven't really been answered. And Ryan was kind enough to mention the whole issue of QE. It's really one particular aspect of the story. Now, I'm going to first of all defend QE when it first started, because I think that back in 2008-09, when central banks began to experiment with these sort of rather weird monetary policies, there really was a genuine risk of another Great Depression. And back then, we were in significant danger of a terrible financial collapse. And just to remind you what happened in the Great Depression, in the US, which was really the forefront of the Great Depression, there was a loss of GDP in real terms of 30%, in nominal terms of 50%, and today, nominal GDP in the US is about 12 or 13% higher than it was in 2008. That strikes me as being a remarkable success compared with what might have been the case had we seen a return to the 1930s type conditions. However, I would argue that QE has morphed from being what you might describe as a kind of powerful antibiotic to becoming an addictive painkiller. Now that we're on this stuff, we find it very, very difficult to get off it. And the longer we're on it, the more distortions it creates within the economy. It creates distortions in terms of the allocation of capital, because of course the financial system is effectively being rigged by the central bank. It creates perverse incentives with governments, because of course if you know that as a government you've got QE coming through, you're not likely to be faced with significantly higher borrowing costs, and therefore there's no particular need for you to cut back on borrowing at any short-term basis. And I fear also, by leading to a misallocation of capital, is leading to the creation of some kind of zombie company story, whereby many companies that probably should have failed have succeeded or carried on, and many companies that should have got more credit have not got the credit that's gone to the zombie companies, which has not been particularly helpful. There are also other issues about income inequality and so on that also have become much more important in recent times. So my conclusion from this is that QE has become rather addictive, and it isn't actually being quite as successful as the policymakers themselves had originally suggested. In fact, the forecasts they made were all way too positive compared with the outcomes that we've seen. So, what are the implications of this story? What are the implications of growth remaining weak? All those promises, those entitlements, whether it's healthcare or pensions or social security, or in the private sector, claims in pieces of paper like stocks and bonds. What are the implications of those claims collectively cannot be met? Well, I have two chapters at the end of the book. The first chapter, cheerfully, is titled Dystopia. Nice, happy story there. And what I'm getting at there is that if there's no political attempt to solve these underlying difficulties, to try and work out how to reduce the claims, if you like, then it creates higher levels of mistrust, not just within countries, but also across countries. And I think one of the dangers there is a rise in protectionism, not just in trade, but also across capital markets. Another danger is the rise of what we describe as populist politics, and actually in Southern Europe, I'd argue, even evidence of extremist politics beginning to come through. And I think the danger is that under those circumstances, you move rapidly towards the kinds of conditions that we saw perhaps in the interwar period, whereby the idea of global coordination begins to fragment, and the globalization model we've lived through over the last 40 or 50 years begins to fall away. What can you do about this? Well, my final chapter is called, I think, Avoiding Dystopia. So there is some sort of positive themes in this book, remarkably enough. And the first thing, I think, is to think about flows of capital around the world. It sounds like a rather esoteric subject. But there's no doubt that before the financial crisis, there were some countries that were saving far too much and investing too much elsewhere in the world. It wasn't just that some countries were borrowing too much, it was also that other countries were saving too much. So we think about the Spanish and the Italians and the Portuguese and so on who borrowed too much. But there was another country in Europe that was lending to them as if there was no doubt the money would come back, and that country was Germany. And Germany had a massive current account surplus, and I would argue that those countries with current account surpluses, like Germany, like Japan, like China, actually made their own contribution to financial instability. And a useful reform for the future would be to say, rather than simply wringing your hands about those who borrow too much, we need a way of actually thinking about those who save too much and what we do about that. And one possibility there is to use the ratings agencies to indicate credit risk warnings, not just for those who borrow, but for those who actually lend, or if you like, misinvest their money in the wrong parts of the world. I think that there's a big issue about an intergenerational balance, because looking around the audience here, I'm thinking that the majority of us are probably boomers. And we as boomers are in a very strong political position. Indeed, I said the majority. I'm definitely at the very tail end of the boomers. But anyway, we're in a very strong political position. When you look at the evidence from general elections, it's very clear that the people in their 50s and above are very good at voting in elections. And of course, there are a lot of them around because it's the boomer generation which is doing all this. But my fear is that the boomer generation has its own selfish interests. It wants to have lots of healthcare and pensions and so on and so forth, which is all very well. But of course it means that education, infrastructure and so on, they get hit very hard. So when it comes to thinking about public spending, the big question, how we protect the interests of the younger generation, which is in the minority, as opposed to the interests of the older generation, which is in the majority. And I don't know quite how we do that, but maybe some kind of new social contract is required to think in those terms. So if you're going to ring-fence public spending, you ring-fence the right bits of public spending rather than the wrong bits of public spending, I can put it in those terms. I think that as far as monetary policy is concerned, I'm actually a fan of nominal GDP targeting. I'm aware that some people think this is inflation through the back door. I want to emphasise it is not inflation through the back door at all. The case for doing it is this. Go back to Japan in the 1990s. One of the biggest problems it had was the fact that the nominal growth was much, much weaker than expected. As a consequence of that, good debts turned bad. good financial contracts turned bad because the ability to repay those contracts fell away as stagnation continued. The advantage of nominal GDP targeting for me is not a macroeconomic inflation through the back door story. It's much more a story of saying, well, if we can protect those contracts by having a certain growth of nominal GDP, and the central bank is responsible for that basic story, then it becomes incumbent upon government and upon society to make sure the split within nominal GDP is advantageous. In other words, it puts much more pressure for supply-side reforms to improve the growth bit and to lower the inflation bit, rather than doing it the other way around of raising the inflation bit and lowering the growth bit. So you effectively have a much bigger story about the supply-side performance of the economy than merely focusing on inflation targeting alone. Banks. There's a severe shortfall of trust for banks, and I argue in the book that there should be perhaps some kind of equivalent of the medical profession's Hippocratic Oath, some kind of code of ethics for bankers, which actually implies not only that they stick to the code of ethics, but there are also clear punishments if they don't stick to that code of ethics, because it's very easy to pursue a kind of rent-seeking bit of behaviour within banking. So how do you deal with this? What sort of code of ethics do you have? Well, you can think of lots of different ways of doing this, but I think there has to be some punishments which involve severe fines, being struck off, and possibly prison sentences for those who are particularly bad. There's no problem doing this in the US, and there's a way you can't do it in Britain if you had to. And then finally, I have to make an apology on behalf of my profession. We economists have really covered the whole situation over the last few years pretty badly, I have to admit this. And I think that one of the reasons we covered it badly is because economics at university is increasingly taught on the basis of brilliant quantitative and mathematical techniques, which relate to the data gathered over the last 5 minutes, sort of divided into the bite-size, computer bite-size pieces of information. And actually this is a terrible way of teaching economics, because most of the really interesting challenges in terms of public policy haven't occurred over the last 5 minutes. They've occurred over the last 100, 200, 300 years. And you'll find in the book lots of examples of historical events where we've hit stagnation, when there have been terrible political and social upheavals. And I would argue strongly in favour of much better teaching of political economy and much better teaching of economic history at universities. Thank you very much indeed.
Thank you, ladies and gentlemen. We've got about 10 minutes for questions, so who'd like to start off? Yes, Ben.
Yeah. It seems to me that we haven't really begun to even tackle the real core of the budget deficit in terms of its sheer size. And one of the results of that is we're going to have to tamper one of the holy cows of the post-war consensus, the welfare state. How far do you think the government can go economically before political pressures will just become unbearable?
Well, it's interesting. I think already there are a few little straws in the wind, so to speak, indicating that perhaps there are aspects of the welfare state that should be looked at more closely. Obviously, the whole social security aspect has already been looked at. But the one I think that is most tricky politically, but also probably needs dealing with, is the health service. I say this partly as someone who's used the health service quite a lot over the years. My middle daughter was terribly ill many years ago, and the health service basically saved her life. So I've got lots of good things to say about the health service, but there are also some bad aspects to it. And with my economist hat on rather than my sort of father hat on, I look back at a report from the ONS that came out maybe 5 or 6 years ago, which was looking at productivity in the health service. You might think this is a relatively straightforward thing to measure, there'll be no sort of controversy given the amount of money that's been poured into the health service. They came out with 5 separate estimates. 2 up, 1 unchanged, 2 down, which is pretty remarkable. We don't even know how to measure output in the health service. If we can't measure that, then there's a big question as to how we can be really sure that we're actually getting, if you like, value for money from the health service. There are different countries around the world that use different kinds of models. I suspect that some kind of pricing will have to be introduced in some parts of the health service eventually, but we're still, I think, a long way emotionally and politically from that. But it seems to me that the ultimate problem is it's run, I think, in a fairly inefficient way, but if you haven't got any pricing at all, it always becomes a queue. Always. I mean, we know from the Soviet Union that's what happens when you have no pricing system. You have queues. It's the other way of rationing resources. So when you hear the stories today about A&E queues being 4 hours or more, I'm not particularly surprised.
Yes, John.
Stephen, I much look forward to reading your book. My question is around banks.
Yes.
And particularly your definition of what is a bank.
Ah.
Is it one, an organisation that lends money to small businesses? Is it two, an organisation that trades on its own account in capital markets?
Yes.
Or is it three, a telco essentially, that's a transaction management technology business? Because I think the definition of a bank will be something that will underpin any healthy economy in the future. I'd be interested in your
Yes.
observations.
Actually, there's a small section at the end of the book on banks. I thought I'd better mention something about them because it's going to be quite important. I think one of the problems with banks is that we have, or different groups of people have different interests as to what a bank should be. So you have the shareholders who want the bank to earn a decent rate of return. You've got consumers who want to have free banking services. You've got regulators who want to have nothing in the way of instability. You've got corporate bondholders who want to make sure the bank doesn't go bust. A whole bunch of different people with competing interests. And I think what's happened as a consequence of all these competing interests is that there have been a series of cross-subsidies in banking. I think very difficult to work out precisely who's doing what. So for example, if society insists on having free ATMs and free checking services, well of course there's a cost to providing those services, but if the cost is not being able to charge directly to the customer, it has to be done some other way. And of course what's happened is effectively that the kind of casino banking part of the story has grown rapidly because that was one way of subsidising the other parts of the bank. So you have to decide in one sense, do we want banks purely to be utilities, in which case you probably break them up into their different constituent parts, or do we accept that a bank is also a device that has to earn money for its shareholder, in which case it has to earn a profit. Then what's the nature of the profit and what does the regulator do about that? But it strikes me that there are, because of these competing claims what a bank should do, that is part of the difficulty that's grown up over the course of the last few years.
Okay, we'll take two questions in this round. Yes.
If you were asked by Mr. Carney what advice you would give him,
Resign.
particularly with an election 2 years away,
Yeah.
what is the nature of the advice you would give?
Sorry, could we do...
And any other questions as well, yes.
And Peter.
Well, in fact, strangely enough, I was going to say something very similar to that,
Yes.
slightly differently expressed. I was going to say, if you could assume that Mr. Carney had approached you, what advice would you give him, which is what my friend said, and which of that advice do you think he's going to reject, and why? For example, I suspect you're anti-QE, but I suspect Mr. Carney may be pro. So it's a similar question, but a little with a few twists.
Well, the first piece of advice is not to make too many promises about what monetary policy can do. And incorporated within that particular piece of advice would be to say, don't rely too much on the exchange rate to bail you out. Because we've had, in 08-09, the biggest fall in sterling since 1931. It worked in 31. It didn't work in 08-09. I mean, if you look at the export numbers in the mid-30s, UK did very, very well. It hasn't done so well recently. So I think, quick fixes don't really work. Secondly, I think there has, clearly Carney is now under pressure and will have to deliver some kind of intermediate threshold in August, because basically at the March budget, this is what George Osborne asked him to deliver. So the question is, what should that intermediate threshold look like? What is the sort of thing to aim for, rather than worrying about inflation 2 or 3 years down the road? What's the sort of intermediate thing to think about? And there is some talk about focusing on unemployment. I think it's a very dangerous game because it brings back echoes of the Phillips curve in the 60s and 70s and how that was abused and broke down completely. And also I think the UK is a very open economy, so let's imagine you have an oil shock, a big increase in oil prices. It raises inflation, it raises unemployment. So do you cut rates or do more QE to reduce unemployment? If you do that, you're going to just raise inflation. So you end up with a sort of paradox. It becomes difficult to sort of set policy in a consistent kind of way. So I come back to my nominal GDP targeting. I would say, look, actually, why don't you, as a central bank, focus on the nominal GDP target, have that framework in place. That's what your job is, and you pass it back to government to then decide how best to improve the split between growth and inflation. You come back to all the sort of supply-side reform agendas that I know this particular group will be keen on, but I think are actually really very, very important. I mean, my basic view, I suppose, is this, that I think the UK and other countries have succumbed to a variant of a Japan-style lost decade disease. And I think that when you look at Japan, despite all the occasional attempts to kickstart the economy through macro policy, I think most of Japan's problem is a much more micro problem, and I think that may be true of the UK and other countries as well. And I think the thing to remember in the UK is that employment growth in the period before the financial crisis was focused on only really three areas: financial services, construction and property, and public sector jobs. The idea that someone can go back to kind of normal growth quickly, because the rest of the world wants to buy stuff that we weren't making for the last 30 years, but we'll buy it in the future, that doesn't really work very well.
There were three more hands up, so gentleman here, gentleman there, and then Ollie.
Stephen, isn't the title of your book inaccurate?
Yes.
Because the money has run out.
Ah,
So,
Not when.
not when.
that's a different question from what I normally get, actually, but yeah, okay.
Yeah, and I would
yeah.
like your answer to that, because the present government, my party in the government, has indicated that they dramatically reduced the deficit.
Yes.
I ask you, have they? Because
Okay.
they appear to be borrowing more and more year by year. And you made reference to the health service. I personally believe that it's quite wrong to exempt the health service and overseas aid and education from any form of cuts, because I go back to Mr. John Reed when he was Secretary of State for Health, who in negotiation with the doctors gave them a settlement which they must have believed was heaven on earth.
Yes.
He doubled their salary and halved their hours. And then we wonder why the A&E in this country is under pressure. Why doctors whom we expect, and my grandfather on my mother's side was a doctor,
Yes.
he was on duty basically 24 hours a day, 7 days a week. Doctors now have opted out of night coverage and
Yes.
also weekend coverage because they're on the golf course or wherever they might be.
Yes.
How are we going to educate a Conservative government to actually deal with the reality of the situation? If you're going to cut the biggest spenders out of any form of cut, we're in trouble
Yes.
forever.
I agree. Yes.
Roger Kendrick. One thing you haven't talked about is expectations and productivity.
Yes.
And we've lived over several centuries, really, where we've had huge growth. People came off the land, we industrialised, then ladies went out into paid employment, then we had borrowing, and then we had the internet revolution and all the rest of it. So we had a lot of drivers there, and during that period, productivity increased. And we've now got to a point where productivity isn't increasing anymore because there aren't many ways of doing it. And the health service is one example where productivity has probably gone down. So my question to you is, if we can't increase productivity, we may not be able to, except in the public sector, do we not have to adjust our expectations? Because we've run out of those things that have provided growth in the past,
Okay.
even with the biggest fiscal stimulus we've ever had, more or less.
Okay.
And Ollie.
I was just wondering, you're talking about nominal GDP targeting, but what would your target for nominal GDP growth be? And if we're below it and you think QE should be off the table, what levers should the policymakers be pulling to try and get back up to target?
See,
So the first question, reverse order?
yeah, you can do. I'll remind.
What levers? Well, first of all, it is below target. I mean, the target I think will be probably maybe, what's trend growth in the UK? 2% if you're lucky, 1.5%. So growth of 1.5 to 2%, inflation of 2%, so it gets you to 3.5 to 4% as a target commitment over the years. You don't do QE, what else can you do? Well, actually, things like the funding for lending scheme are probably better than QE in many ways because they deliberately try to do something about getting money, incentivising banks to lend more money to different parts of the economy. I think that there needs to be, actually going back to the Mark Carney question, there needs to be much clearer regulatory environment for banks, because one of their biggest concerns is that they don't know what the regulatory environment will be in 5 years' time, and therefore they're constantly deleveraging when perhaps they shouldn't be. That would be very, very helpful. I would, if I were Carney, I would go back to the government and say, actually, if you want to improve this split, it's about your reforms, not my reforms. I can give a framework. You have to improve the split. There's an element of, I was criticised this by someone, but there's an element of the 1980s medium-term financial strategy about this, which is that effectively, well, the NTFS was designed to say macro policy for controlling inflation, micro policy for bringing down unemployment. And in one sense, I'm trying to argue the same sort of thing in a slightly different way, which is to say that macro policy can provide a framework, but to actually get the economy growing properly, you need to have a lot of micro policies coming through. And the question of productivity and expectations. Well, recently productivity has performed very poorly, and not just in the UK, actually. The recent US numbers have been poor as well. The US had a better start to the exit from the crisis, but recently the numbers there have faded as well. I'm not really a productivity pessimist in the sense of arguing that the best technologies have now run out. You know, there are people like Robert Gordon, the sort of rather miserable economist in the States, Northwestern University, who came out with a paper recently with basically saying not only have we got the population problem and the women problem and the trade problem and the consumer credit problem, we've also got a technology problem. I'm not so sure about that. I mean, we've seen tremendous increases in technology and they will continue. I think the problem is that we've assumed that technology is the only reason why we're growing quickly, and I don't think that's right. So if you go back to the Industrial Revolution, look at the growth rates in the 19th century, they're a lot lower than we got in the 50s, 60s, 70s and 80s. And my point is that you may have great technologies coming through, but you should be cautious about what kind of growth you'll get. And that comes back to the expectations problem, because if the growth is lower, because technology alone can't deliver the normal growth rates, then of course the gap opens up between expectations and reality, and my view is that gap already has got quite big. Now,
The deficit and health spending.
the deficit. Right, first of all, has the money run out? No, because the government can fund itself. You might think it's wrong to have a big deficit, but it can just
We're
give it
funding.
away. We're funding it, you're right. But there are enough creditors around not to create a kind of buyer's strike that has led to a terrible collapse. So in that sense, the government is perfectly okay in current circumstances. In fact, in the book I advocate, in terms of deficit reduction, a model which is not so dissimilar from the Grad-Rubin-Hollings process in the US in the 1980s and 1990s, because this was a process of automatic sequestration every single year. I mean, you know, Congress had to decide on the spending cuts. If they couldn't, there'd be automatic sequestration. But there was a rather useful safety valve, which is that if you went into recession, the process would be postponed for a year. And of course, they never really asked the question, what happens in recession every single year? That'd be more difficult. But they effectively said, we don't want to get into a vicious downward spiral where we're forced to tighten fiscal policy aggressively in a period of extreme economic weakness, because that may just lead to a kind of Greek-style collapse. Well, he didn't say that at the time, but that's what would have happened subsequently. So I would argue there should be a commitment over the medium term, 5-10 years perhaps, to deficit reduction with escape routes. Because one of the problems that the Chancellor's had is not so much his intention to cut the deficit, but rather the growth assumptions underneath it were wrong. You know, he might have gone out intending to do everything that he wanted to do. It was based on wishful thinking from an economic growth point of view. So it comes back to my underlying issue, which is that growth is much lower than was the case previously. What do we then have to do? And this is why I think that politicians are so keen to believe that the future will be much rosier, because it lets them off the hook for doing the tough things that might otherwise be required. And that's where you get into a real sort of conflict.
But what about the health service and exempting that from any cuts in education and overseas?
Well, I think the problem is if you exempt a particular department from cuts altogether, you're basically saying that department can do whatever it wants. There's no pressure on it. And you know, you have market pressure or you have political pressure, but if you've got neither of those things there, then I think the risk is that you know, any inefficiencies that already exist will just remain. And I share your view on doctors. I mean, I think that was a pretty extraordinary thing. And that's why, of course, the queues at A&E are so incredibly long now.
Absolutely.
Ladies and gentlemen, thank you for listening so attentively and asking such fantastic questions. I'm sure if you'd like to come and buy a copy of this book for just £17, Stephen will be happy to sign it for you. And if you could all put your hands together, I'm sure you'll agree it was a fantastic